The U.S. tax code is broken, and you can feel it right now because millions of Americans are doing their taxes. So this is the perfect moment to ask why tax season feels like a ritual of national suffering for normal people, while some of the richest people in America seem to glide through the jungle untouched. Welcome to another episode of Planet Econ. Even before we get to billionaires, it makes ordinary people waste an absurd amount of time and money just figuring out how much taxes they owe. The IRS's own instructions for Form 1040 say the estimated average burden for all taxpayers filing a Form 1040 or 1040-SR is 12 hours and about $290 per return, with non-business filers averaging about 8 hours and $160, and business filers about 21 hours and $610. That is already a giant economic cost before a single dollar of tax revenue is even collected. It is like the government saying, please hand us your dough, but only after you complete a scavenger hunt, a Sudoku, and a blood oath. And that complexity is not just some tragic accident of nature. Enter the tax prep companies, swinging in on vines made of lobbying. In 2002, the IRS entered into a free file agreement with the Free File Alliance, and the Federal Register notice said participating companies would offer free online filing to at least 60% of taxpayers. That meant the government leaned on private software firms rather than fully building its own universal simple filing system. Over time, that created an obvious incentive. If your business makes money helping people navigate a messy filing system, you're not exactly rooting for the system to become beautifully simple. And the evidence suggests those firms did fight simpler alternatives to the mess that we have now. ProPublica reported that Intuit spent years using lobbying, revolving door relationships, and manipulative design tactics to resist efforts to make filing free and easy. Open Secrets found that tax prep firms had spent about $90 million lobbying on free file, direct filing, and related issues since 2003. Among other things, the tax filing companies are trying to pass off as doing enough public service with their free tax filing option. Heard of TurboTax? In 2024, the FTC issued an opinion finding that TurboTax's parent company, Intuit, had engaged in deceptive practices around free claims for TurboTax. So the clean version of the story is not TurboTax personally wrote the current tax system. The clean version is that a profitable industry had strong incentives to preserve a confusing filing experience and push back against simpler public options. How are they doing it? By throwing millions of dollars at trying to convince the government that their meager free filing programs are enough. And from an economics perspective, that's incredibly inefficient. Usually, when economists talk about the cost of taxation, they talk about how taxes distort people's decisions and create deadweight loss. But complexity creates another layer of waste: hours of paperwork, lobbying, and millions of people spending real time on compliance instead of on anything productive or enjoyable. If the state already has your W-2, your employer already sent the information, and yet you still have to spend hours proving numbers the government often already knows, that's not elegant public finance. That's administrative inefficiency dressed up as a yearly tradition. But the second way the tax code is broken is even bigger. It's much better at taxing ordinary work income than billionaire-style wealth. The IRS says the federal income tax is pay-as-you-go. You generally pay as you earn or receive income during the year. And if you're an employee, your employer probably withholds tax from your paycheck and sends it to the IRS in your name. So for workers, the tax system is not lurking in the distance. It's right there in every paycheck, already chewing. And yes, the ordinary income tax is progressive, but the IRS also says most net long-term capital gains are taxed at lower rates of 0%, 15%, or 20%. So even before we get to the fancier billionaire maneuvers, the code already treats money from labor and money from asset ownership differently. Paychecks take the stairs. capital gains get a VIP escalator. And that matters because the richest people in America do not get rich mainly by collecting giant weekly paychecks. A huge share of their economic gain comes from assets going up in value. Danny Yoggins' paper, 2023, estimates that the 400 wealthiest American families paid an average federal individual income tax rate of 9.6% over 1992 to 2020, when income is measured more comprehensively to include changes in wealth. The key reason is that unrealized capital gains are a major form of income at the top, and those gains often are not taxed under the individual income tax until they are realized, usually through sale. So the teacher earning a salary is fully visible to the tax system, while the billionaire whose stock position just rose by another few billions can become much richer without triggering any tax increases that are remotely proportional that year. That's why people talk about buy, borrow, die. First, buy assets that appreciate. Second, don't sell them, because sale is often the event that triggers capital gains tax. Third, borrow against them. Borrowed money is not itself treated as taxable income, so if you have enough appreciated wealth, you may be able to access spending power without realizing gains. It's the tax equivalent of telling the government, no, I'm not rich, I'm just temporarily surrounded by extremely valuable things. Then comes the die part, which is where the code stops being quirky and starts looking like performance art. The IRS says inherited property generally takes a basis tied to fair market value at the date of death, which means that a lot of appreciation during the decedent's lifetime can disappear for income tax purposes when heirs inherit the asset. The IRS also says the estate tax exclusion for 2026 is $15 million per decedent. So yes, some very large estates can still face estate tax, but that's separate from taxing all of the lifetime appreciation as income. The result is that large amounts of gain can escape ordinary income taxation entirely. That's not a tiny crack in the wall, that's the wall. And historically, America has not always been so relaxed at taxing the top. The Tax Policy Center's historical table shows the top marginal federal income tax rate was 7% in 1913, rose as high as 94% in 1944 and 1945, stayed around 91% through much of the 1950s, sat at 70% for much of the 1970s, dropped to 50% in the early 1980s, fell to 28% from 1988 through 1990, and stands at 37% today. That doesn't mean rich people literally paid 91% of every dollar they earned back then. These are top marginal rates, not effective rates. But it does show that the underlying philosophy of the tax code has shifted dramatically over time. The same thing is true for capital gains. Tax Foundation's historical table notes that from 1988 to 1990, capital gains were effectively taxed like ordinary income, which was the rare period when the usual special preference for long-term gains basically disappeared. So when someone says, well, of course capital income gets better treatment, that's just how taxes work, the answer is, no, that's how this tax code works. The country has made different choices before. And this matters even more because wealth is so concentrated. The Congressional Budget Office reported that in 2022, families in the top 10% held 60% of all wealth, while families in the top 1% held 27%, up from 23% in 1989. So a tax code that struggles to tax unrealized gains isn't missing some little side pocket of the economy. It's missing a huge share of how economic power grows at the top. If the richest people get richer mainly through assets, and the tax code mainly bites when income looks like wages, then the system is targeting the wrong prey. Now here is the part that makes all of this extra maddening. Taxes themselves are not the villain. Taxes are how governments raise money for the stuff markets undersupply on their own. The market itself does not supply enough public goods like national defense and roads, so the government needs to step in to supply them via tax dollars. A factory that pollutes like crazy does not really care about the bystanders it is hurting, so the government needs to step in to regulate pollution. So taxes are how a society pays for the boring, massive machinery that keeps civilization from turning into a feral parking lot. Thus, society needs a tax code, but not the current broken tax code that we have. So what are an economist's favorite form of taxes? We love lump sum taxes, or taxes that are just a straight payment from you to the government, but are not tied to any decisions you make. Why do we like lump sum taxes? Say instead of doing lump sum taxes, the government, like what's actually happening now, taxes you a certain amount every time you buy an apple. Say it costs the firm, on average, 90 cents to produce an apple, but you are willing to pay $1 for the apple because eating an apple makes you as happy as getting $1. With no taxes, you would buy the apple. You are happier because you gained $1 worth of happiness with 90 cents, and the firm is happy because it made some money. However, say now the government comes in and taxes 20 cents for every apple you buy. Now you have to pay $1.10 to buy the apple, but the apple still only gives you just $1 worth of happiness, so you would just not buy the apple. You are now less happy than before the tax, and the firm is less happy. The government also gained nothing from you here because you didn't end up buying an apple, so it cannot tax you. In other words, taxes that attach themselves to certain actions simply suck happiness away from this world. The total amount of surplus you, the firm, and the government get with the tax, all added together, is smaller than the total amount of surplus you and the firm got before the tax was in place. Some happiness just simply disappeared. Economists call this disappeared happiness deadweight loss. So economists would ideally like a lump sum tax system where taxes are collected in a straightforward manner and used to improve society. And once you see that, the American system looks ridiculous in a very specific way. We do not have some beautifully efficient tax system that is merely a little progressive. We have a system that imposes real compliance costs on ordinary people, lets tax prep companies make money from that complexity, taxes wage income quickly and visibly, and often lets huge fortunes grow through lightly taxed or untaxed appreciation, non-taxable borrowing, and basis step-up at death. In other words, we are paying plenty of distortion costs, but not in exchange for some glorious triumph of fairness or simplicity. We are getting the worst of several worlds at once, and a lot of happiness that could have been there has been sucked out of the world. So the current U.S. tax code is broken because it makes regular people hack through a compliance jungle, allows private firms to profit from keeping parts of that jungle dense, and still does a weak job taxing the forms of income that dominate at the top. The hard-working person with the W-2 gets taxed on schedule, the company selling tax software gets paid to interpret the maze, and the billionaire sitting on a mountain of unrealized gains keeps looking down at the whole thing and asking, with a straight face, what income? Thank you for watching another episode of Planet Econ. If you enjoyed this episode, please like, subscribe, and consider supporting Planet Econ on Patreon. Stay curious and see you next time.